first want to start with October, really volatile. From your perspective as sort of an asset allocator, where are you positioning? How are you telling clients on sort of where to go given sort of, it's been a rough year?
It's been a really interesting year, and the markets have been in a bit of a state of flux the whole year long. And I think what that has done is led to a number of conversations about the use of hedge funds in the portfolio. It's very important for clients to remember what they're putting the hedge funds into the portfolio for, the purpose that they want these strategies to take in their overall asset mix. And in terms of October, one of the more interesting things about that is there was a true dispersion in the performance of the managers. It wasn't all completely negative. It was certainly disappointing, I would say broadly, but we saw a number of strategies go ahead and make money. And I also think that in times like this, it's very illustrative of the type of manager that you're picking. So manager selection becomes a really, really important factor when markets are broadly struggling and changing.
And what is that? Is it long short that outperformed? Is it long volatility that outperformed? You know, what are sort of like the key spots here?
We saw minimal but bright spots in pretty much every strategy. We saw some bright spots in sector-focused long-short equity. We saw bright spots in multi-strategy hedge funds. Relative value, again, when markets are in transition and you're starting to get some disparity between the movements in the markets and a decrease in the correlation between the factors in the markets, this is an opportunity for hedge funds to position themselves to do what they do best, which is buy one thing and sell something else. So relative value overall has been an area that we've been very interested in.
Michelle, Taylor brought up the filings that we're going to get on Wednesday. Any kind of thoughts on what you think those filings are going to show in terms of how the hands have been played by some of the bigger names?
I think there's an incredible amount of data that's out there now that folks are using to inform themselves in their investments. I wouldn't go so far as to say that there's going to be one particular theme in the 13Fs, but I think it's just another piece of data that the managers will use to try to construct the best portfolios possible.
Michelle, there's a nice story on the Bloomberg this morning talking about AllianceBernstein and how it is using the AI and the machine learning that you just referred to. And what really caught my eye in that piece was that they're very actively working on ways to discover liquidity at the moment, particularly in credit. I'm curious to get your take on how much work is going into this. How easy is it to figure out liquidity? Because when the credit market turns, that liquidity is going to be pivotal.
I think liquidity is a tremendously huge focus across the security spectrum in the markets today. And if you think about liquidity provision, at this point, it's really a profit center. It isn't a service or a warehousing of risk. Market making is a profit center. And I think if you consider some of the different sectors of the market, you specifically asked about credit. But there's been a full-on commoditization of the market making across commodities, across equities, and that is now moving into the credit markets. And one of the things that my firm, as well as many others, are doing is using the power of technology, using the power of machine learning to try to really navigate our way through the ups and downs in the liquidity spectrum of the market to find the deepest pools of liquidity and to eliminate the drag that you get by crossing the bid-offer spread when you're executing your strategies. This is something that our firm has focused on for a great deal of time, and it's really where a lot of the machine learning techniques have actually been put to use.
We can't talk about hedge funds without talking about fees. In this era of a race to the bottom in terms of cutting fees, how do you justify a 2 and a 20 right now?
So this is a conversation that is held repeatedly, and I wear the hat of both an allocator from the fund-to-fund side of our business, but I also represent, single hedge fund managers as well. And as an allocator, the thing that I try to keep first and foremost in my mind is that we are paying appropriate fees for the amount of risk that we're taking and the return that the manager is generating, which means not every hedge fund in the universe deserves 2 and 20. What I do see, not only from my own allocation history, but from the work I do with institutional clients, is investors are willing to pay 2 and 20 if they're getting what they bargained for. If they are getting differentiated, uncorrelated return on a consistent basis at appropriate risk, people will pay the fee. if you are providing equity beta, or you are just an asset aggregator, or are falling short of what you're telling your investors you're going to do, you don't deserve 2 and 20. And I think going forward, what big asset managers are going to have to do is offer an array of product at different pricing points that very specifically address the type of exposure and risk that the investors want to take.
Michelle, one final quick question from me. If October was a sort of pre-shock in the way that we are going to be progressing from here, in terms of the fact that at some point we are going to get a downturn, what do we learn from it in terms of, as you say, the correlation with the market? How uncorrelated was the hedge fund community during the month of October?
Interestingly, I think that the hedge fund community was actually less correlated in October than they were in February. If you think about coming into the year, at the start of the year, risk on was very much what was in momentum at that time. So hedge funds overall, I think, were very heavily oriented towards risk assets. And what's happened over the course of the better part of this year is that most hedge fund portfolios are now positioned much more defensively. And I think that they are better positioned to handle the volatility and sort of the what-if scenario that we kind of sit in the market. We're sort of at a simmering boil right now, sitting in between the opportunity for some kind of policy risk or inflation. Mm-hmm. And the managers are sitting there with much more balanced portfolios, less exposure to equity beta, and probably better suited to respond and provide the diversification that investors expect from those investments.